Well, good afternoon, everybody, and thank you so much for joining us at our inaugural 2020-2021 season of the Money Marketeers. We are very fortunate today to have President and CEO Tom Barkin from the Federal Reserve Bank of Richmond speaking to us today. If I might, just a moment or two of housekeeping. We are the Money Marketeers of NYU. We are a philanthropic organization whose focus is raising scholarship funds for eligible students that are involved in the Stern NYU School of Business. Our forum, by and large, is a forum for engaging meaningful and substantive dialogue with U.S. policymakers, senior Federal Reserve Fed officials, and other distinguished speakers whose words and actions have the potential to influence the global financial markets. And we look forward to those of you that are new to our forum to inquire about us, and if appropriate, maybe apply for membership. With that being said, let's please focus on our esteemed guest today. We're very lucky to have Tom Barkin speak with us today. Tom is the President and Chief Executive Officer of the Federal Reserve Bank of Richmond. In this role, he is responsible for monetary policy, bank supervision, payment services, and the Fed's national IT organization. So a lot to do. He serves on the Fed's chief monetary policy body, the Federal Open Market Committee, and he is on the ground continuously in the Fed's 5th District, which covers South Carolina, North Carolina, Virginia, DC, West Virginia, and Maryland, and has brought real focus to the less prosperous parts of that district. Tom joined the Richmond Fed in January of 2018, and before that time, he was a senior partner and chief financial officer at McKinsey & Company, a worldwide management consulting firm. He also oversaw McKinsey's offices in the southern United States. Tom served on the board of directors for the Federal Reserve Bank of Atlanta from 2009 to 2014 and was the board's chairman from 2013 to 2014. He is a member of the Emory University Board of Trustees and the Greater Washington Partnership. Tom is a native of Tampa, Florida, and attended Harvard University, where he earned his undergraduate MBA and law degrees. And with that, I would love to introduce Tom Barkin, whose speech is entitled "The Economy and the Question of Inflation," a very appropriate and timely topic. Sir, thank you for joining us.
And thank you for having me here today, even if it is virtually. I really do hate that we can't be together in person and hope that we can sometime soon. I thought I might give some quick perspectives on the economy, but I'll dig in mostly on a topic that seems to me to be generating a lot of interest, which is the question of inflation. These are my own thoughts, not those of the Open Market Committee or the Federal Reserve System. And I say that in part because it's required, but also because it lets me be as direct as I want to be. And I'm very much looking forward to hearing your questions and comments. As Alan said, my background is business, not research. So I hope you'll find some of these views relevant and interesting. Let me start with the big picture before turning to the latest data and then inflation. You guys all know this. Economic activity fell off a cliff in March and April as we shut down. It increased rapidly in May and early June as the economy reopened, and then began to flatten in late June and July as the virus resurged. Over the last month, the virus has receded somewhat, though cases remain at elevated levels while the death rate has dropped. Vaccines are becoming more proximate by the day, but their rollout and effectiveness are still hard to predict. Recent data, most notably the jobs report, has surprised on the upside. Congress has not yet passed another stimulus measure, which creates risk to the less fortunate. Though to be fair, we haven't seen much impact in the numbers so far. So where are we then? Given the steepness of the drop, trying to interpret rebounding growth rates is confusing, so I prefer to talk levels rather than rates. Where are we today versus where are we pre-COVID? The unemployment rate is 8.4%. That's up from 3.5% in February. 12 million fewer Americans are employed, a drop of 7.6%. Spending is coming back faster than employment, though. Real PCE, which you know is 68% of the economy, is down 4.8% from its January peak. And within that, spending on goods is actually up 6.4%, while services spending is down 9.7%. Our best proxy for business investment, new orders of non-defense capital goods, excluding aircraft, is down 0.5% since February, though it was lagging at that time. And of course, government spending is up 53.7%. as fiscal policy is attempted to bridge the downturn. But today, I want to focus on a question I've been getting an awful lot these days. Are we at risk of seeing escalating inflation? Now, if you focus on the data, this question could be a bit surprising. our inflation target is 2%. Over the last 20 years, headline PCE inflation has been 1.8. Over the last 10 years, 1.5. Over the last year, 1.3. Over the past 6 months, 1%. That certainly doesn't look like a path of escalation, at least so far. And if anything, financial markets seem more concerned about low inflation, not high. TIPS break-evens were 2.3% in 2007. They're 1.6% today, and were even lower, of course, a couple months ago. On the other hand, I can understand why people might expect that higher inflation is on the horizon. Some people worry about the actions the Fed has taken in response to the pandemic. After declining after the global financial crisis, the size of our balance sheet has surged to unprecedented levels, from $4.5 trillion to $7 trillion. As a result, M2 has expanded. To the casual observer, the actions the Fed has taken in recent months might look like the kind of money printing that has historically been associated with inflation. The Fed has also lowered interest rates to near zero and pledged to keep them there for a long time. As Chair Powell said in a recent press conference, we're not even thinking about raising rates. Our recent changes to our monetary policy framework and last week's statement support modest overshoots of our target to bolster inflation expectations. While this guidance should help support economic recovery, some might fear it could de-anchor inflation expectations. And like the Fed, the federal government has taken unprecedented action in response to the pandemic. Congress passed a $3 trillion stimulus package in March, and lawmakers continue to debate further stimulus. Federal debt has risen to its highest level since World War II. Fiscal spending could pressure prices, and at some point, mounting government debt could trigger inflation if investors began to believe that the Fed would not raise interest rates when necessary. On the consumer side, households have witnessed supply constraints firsthand for food and household items, leading to higher prices at the grocery store, for example. Indeed, according to the University of Michigan's survey of consumers, inflation expectations ticked up from 2.1% in April to 3.2% in May. While they've declined to 2.7% in the preliminary September results, that's still high relative to the last few years. The core consumer price index has expanded at a 5.1% annual rate in the last 3 months. And one could imagine an inflationary scenario, perhaps with the rollout of an effective vaccine, where demand comes roaring back at a time when supply is still constrained. Even though it was 45 years ago, many of the people I talk to are part of the generation that still remembers the great inflation of the 70s. So I can understand how, with all that perspective, these things might be alarming. That said, I see the recent tick up as just a natural rebound from a deflationary second quarter. And while it's certainly possible that inflation could escalate in the near future, I have to say I'm less worried about that possibility. In 2008, the Fed started paying interest on the reserves it issues. That change means that a larger balance sheet doesn't have the inflationary impact it might have in the past. Instead, think of it as merely a reduction in the maturity of outstanding government debt, as the Fed issues short-term debt in exchange for longer-term debt. That's quite different than printing money. And our surveys show that banks are tightening standards, so there's little evidence that the increase in reserves is fueling an explosion in lending. On the fiscal side, the savings rate in the second quarter was 26%. It was still 18% in July versus about 8% pre-crisis, suggesting that fiscal stimulus isn't yet overwhelming supply either. And recent experience internationally has taught us that our capacity to take on additional debt may be higher than we previously thought. The last global recession was similarly accompanied by fears of inflation from fiscal and unconventional monetary stimulus. Instead, we saw low and stable inflation here, in Europe, and in Japan. What might explain this? In today's environment of stable inflation expectations, I see moderate inflation driven largely by market power and price transparency. Greater price transparency facilitated by the internet may have increased consumer price elasticity and thereby dampened the responsiveness of inflation to resource pressures. At the same time, the rise of national low-price retailers and non-market purchasers who leverage very aggressive professional purchasing disciplines and global alternatives has made sellers reluctant to raise prices. Economist Thomas Philippon's recent book on declining competition in America is compelling, but he really only talks about purchasing power in a labor context. I actually think it has even more impact on the price of goods supplied. Still, if these forces dissipate, say through deglobalization or antitrust, or if inflation does start to rise despite these forces, the Fed has proven effective tools to fight it. We may be limited in lowering rates below zero, but we don't face the same constraint when it comes to raising rates to respond to inflation, should it appear. Now, as you well know, the recent focus of our profession has actually been to try to create a little more inflation, not less. And I would count myself among those who think a little more is welcome, so that we don't continue to be persistently below target and perhaps reduce expectations going forward. Our recent revision of our long-run monetary policy framework was in part intended to find ways to boost inflation and inflation expectations a bit. So I try to be humble about our ability to impact inflation, given the market forces I've described. So as I evaluated these changes, I always asked myself whether the medicine was worth the pain. While inflation has run below our 2% target, as I said earlier, it's not that far off target. With rounding, you could even call it on target. Moreover, inflation expectations are stable and well anchored. Monetary policy doesn't operate with precision, so efforts to create a little more inflation do risk de-anchoring expectations and taking us higher than we want to go. That's why I like where we landed in our new framework, making clear our willingness to have an overshoot, but only a moderate one. Wednesday's statement reinforces that message. I think that moderation limits the risk of de-anchoring while sending a positive signal on inflation. Of course, our review also considered aggressive versions of makeup strategies where the Fed commits to a formula to make up for periods where inflation has been below target. You'll note that our language, average over time, permits us to look at our longer-term track record, while the chairman has made clear we're not committing to a precise formula. I'm happy with that balance too, as I remain skeptical of formulaic commitments. Such commitments depend heavily on the central bank's credibility to bind their successors to suboptimal decisions in the future. I was reading Harry Potter with my niece, and I just note that unlike Snape's commitment in Harry Potter, monetary policy doesn't have an unbreakable vow. I also welcome the acknowledgement in our framework that meeting our mandate requires a stable financial system. Holding rates low for a long time also can have negative consequences. It generates reach-for yield behaviors that can lead to market volatility. It narrows the interest rate spread that so many community banks depend on. It can lead to excess leverage, since borrowing is cheap, which can make future financial contractions more painful. So I don't see lower for longer as zero forever, and I'm hoping we can move toward normalization when the time is right. And if risks arrive, last week's statement gives us freedom to act. Thinking more broadly, I want to emphasize that for now, I remain focused on unemployment, given the huge gap where we are today, 8.4%, and our target. As we learned from our recent Fed Listen sessions, the public doesn't see raising inflation as an urgent concern. And I agree with those who see our new framework as evolution, not revolution. Luckily, I guess, at a time when we're missing both targets, there's no conflict in giving maximum stimulus, as we're doing today. I'm hopeful our new framework will be of value. As we implement it, I'm personally committed to being opportunistic. When inflation nears or slightly exceeds 2%, I hope to celebrate that and not be too hasty to quash it. I'm also committed to being optimistic. Industry takes its cue from us. If we persist in pursuing 2% and show confidence in our capabilities, price setters will follow. In contrast, the more we bemoan any lack of success, and remember, I remain humble about our capabilities, the more impetus we give them to push purchase prices down. Now, recognizing the risk that I'm doing just that, I'll commit to tearing up this speech once I'm done. And for those who continue to worry about whether inflation will explode, I guess I come back to a few key thoughts. It hasn't yet. It didn't after the last downturn, despite similar concerns in the US, Europe, and Japan. Powerful market forces have been helping keep it in check, and I don't anticipate that they will dissipate anytime soon. And should inflation emerge, the Fed has the tools and the will to address it. Thanks, and Alan, I'm now open for questions and comments.
Thank you very kindly, sir. Just as by way of everyone on your dashboard, you should see a sort of a drop down where you can ask a question. A few of you have already started asking questions, of which I'll sort of go through, but now is the time to utilize that capability. And thank you, sir. That was wonderful, and especially given the topic of inflation, where everybody is certainly trying to put it in historical context, as you mentioned, vis-a-vis the 2008 scenario where QE and really was sort of brought out to the universe. Now we have COVID-19 and Corona to sort of address this current downturn. And one of the first questions that came through that I think is actually starts out of almost like a 30,000 foot view is how does the Fed get comfortable with trying to marry the uncertainty of COVID while providing, let's call it, a firm stance on policy at the exact same time?
Well, I do think, we're in a time of quite elevated uncertainty. And if you look at some of those indices that measure uncertainty, like the Bloom-Davis metric, you'll see it. It's just quite elevated. There's virus uncertainty. There's uncertainty on whether we'll have more fiscal stimulus or not. There's election uncertainty. I think there's a lot that's out there. And I think as I thought about the forward guidance that we gave last week, I might have instinctively thought in a different scenario that date-based was, a simpler way to go. People could understand that very clearly. When you've got this amount of uncertainty, I think you turn more to outcome. And that's why outcome-based forward guidance made sense to me. It helps navigate the uncertainty. And just like any company, when you're faced with uncertainty, you try to do stuff that takes the uncertainty out of the equation. So again, that's part of what made outcome based forward guidance compelling to me. It allowed you to get around the uncertainty. If the economy comes back strong faster, that'll tell us something. If it's slower, that'll tell us something. And I think the markets, have a natural adjustment mechanism to that as well.
Sort of following along, sort of that viewpoint of outcome based. The follow-up question to that I think makes sense is, now that forward guidance for rates has been effectively completed to a certain extent, or at least for the time being, will the Fed address forward guidance for its asset purchase program as well, sort of by year end? And will that also be threshold based, similar to rates?
We'll have to see. I'm a believer in what I've called before horses for courses. You decide on what you're trying to do based on the circumstances you're in. I do think we had prior guidance on the asset purchases that were around helping facilitate market functioning. I think in the latest statement, what we acknowledged is that in addition to supporting market functioning, they also were providing accommodation in the way that QE did as well. In the last recession, I believe the guidance we gave on the asset purchases was around labor market strengthening. We'd continue asset purchases until labor market strengthened. So I don't know that we have any track record of more specific forward guidance, but of course that's a conversation for some time down the road.
Sorry about that. Additional question, and I think this goes back to sort of a topic that was related to and certainly from my perspective in the last recession, but any concerns given sort of monetary policy and what the Fed is doing right now about non-banks or the shadow banks that was really at the forefront in the previous crisis, or is that, how does that fall into your analysis?
Oh, I do worry about the parts of the system that we don't see. We have regulatory oversight for the banks, and particularly the big banks. And I do think a lot has been done in the last 10 years by those banks and by those who oversee them to put more capital in the system to get a better risk management processes. And at least so far, I think you see that in the performance of those banks. There's then a whole wide part of the world that we don't see and we don't oversee. And I do worry what risks are embedded in that. A classic example would be what happened to the Treasury market functioning in March. And we started buying all these Treasuries because the bid-ask spreads, widened significantly. What was going on there? And so I think there's a constant search to say, what is happening out there, and how do we somehow get our hands around it? And I do worry that there are lenders with different credit profiles, that there are balance sheets on institutions that have leverage built into them that we don't understand, and that's certainly something that needs real focus.
Additionally, and I'll just read the question verbatim if you don't mind. You seem to suggest.
No, that's a signal that you don't really like the question very much. So I can't wait.
I like the question, but I was trying to figure out a way I can sort of shorten it a little bit. But I think the asker did a good job, and it's really more your thoughts on it as opposed to sort of like a concrete answer. Is in a quote here. You seem to suggest that there is some sentiment-driven dynamic between the Fed's confidence on inflation target versus price setter behavior. Can you elaborate more on that and whether actual demand response is more of a leading indicator on how price setters behave? If you will, chicken or the egg in that.
Yeah. Well, so if I can, and I spent a lot of time in this dynamic in my time, my prior career. But if I could, paint for you a picture, I guess, of what it must feel like to be a goods manufacturer who sells into a big box retailer, a Walmart or a Home Depot or one of those things. Everyone knows that our target's 2%. People are raising their wages 2 or 3%. And so that's sort of an embedded thought. That's sort of the essence of anchored expectations. In that environment, the purchasers at a big box retailer, they think their mission is zero price increase because they sell at everyday low prices, and they're successful if in a 2% inflation environment, they hold price increases to something like zero. And that dynamic is a very powerful one. And if you talk to people who sell into those providers, they are very, very reluctant to raise prices. And even in the context of tariffs, when those sorts of things were happening, very reluctant to pass those on because the purchaser on the other side has a lot of market power and a lot of options, including going overseas and finding lower cost alternative suppliers. Just imagine now a scenario where Home Depot or Walmart didn't think that inflation was going to be 2%, but thought it was going to be 0%. Well, then those purchasing guys, might think that the only way to win is to go to a -2. And so there's a bit of a risk if you lose inflation expectations that it will reinforce itself. That these big box retailers in the middle will start driving prices further down, and that's why I do think we have really well anchored inflation expectations. I think there is no reason for people to think that, but that is why I and perhaps others worry about inflation expectations, because you want to make sure you maintain them.
Effectively the slippery slope. One additional question, obviously on this topic. It says the FOMC statement avoids specificity on what moderately exceeds 2% means for inflation. Can you give any indication of what would be high enough for you to trigger tightening, realizing inflation expectations, things of that ilk?
Yeah, there've been a lot of questions, I think, trying to get my peers and others to describe whether it was 2 to 2.5 or 2 to 3, or whether it was a trajectory here, there, the other. I think moderate is moderate, and all of the comments my peers have given are comfortable to me. I think it's the totality of the circumstances. How steady or not steady is inflation? How far over is it, and for how long? But I've spoken publicly before and said I actually would have been comfortable in this review with adopting a range, and whether that range was 1.5 to 2.5 or 1 to 3, any of those are sort of fine to me. I think, like I said, it's all in the zone of rounding to me.
Thank you. Follow up onto that. Let's shoot forward about 6 months, give or take, and we're not seeing the excitement of inflation in any significant regard. What do you anticipate sort of the next potential steps that the Fed could do, or maybe 6 months isn't long enough, you'd want it to play out over a year's, or whatever the time frame you find appropriate to sort of reevaluate your core belief. What are the capabilities that the Fed is starting to look at? Is it simple stuff like increased QE size, maturity extension, or are there some additional sort of ideas or manners that the Fed would look to implement?
Well, I guess I should say at the beginning, I don't think of Fed as the only actor in this. I think there are 3 actors in this. One of the public health authorities, and you're not going to get, for example, airline prices up unless you get people comfortable flying. And so I think public health has a huge impact here. The second are the fiscal authorities, and particularly when it's coming to promoting inflation, increasing demand in that sector is relevant. And then you've got the Fed. And so I think all three play it. We've now gone to a world where we've sort of set a dial here that makes a pretty strong statement, I think, in terms of trying to boost inflation expectations. And I'm hopeful that the other actors will take the necessary steps to support that. I'm not over-focused, given the fact that you've got the potential for us rounding over fiscal stimulus with fiscal restraint, that we've got the potential for a virus to last longer than I certainly hope it does. I'm less focused on month-to-month inflation and more looking at expectations. And if expectations went down, that's what we'd have to be thinking about. But I importantly think those actors have a role too, in addition to us.
This one's a little bit lengthy, but I think it's a good one. In February, Governor Quarles spoke to our organization, and it was a wonderful speech. And he suggested that the benefits of treating U.S. Treasuries and cash as substitutes under stress by making the discount window function as an explicit liquidity provision during stress, allowing banks to treat Treasuries as cash on day one of the outflow and stress, and so on and so forth. And then the Fed to use the discount window as part of liquidity planning will make it easier for banks to expand U.S. Treasury holdings and put some cash to work, further enhancing market functioning. In your opinion, what can the Fed do to further develop this idea proposed by Governor Quarles?
Well, after, he said it was February was his speech? Yeah, so in March, I mean, you would have noticed several things that we did do, maybe it was April, certainly about reserve requirements, certainly about rate at the discount window, also about how we treated some of treasuries and the leverage ratio. And so I think we did, make some very real changes to try to support it. And I think the discount window got a lot of use in the last, in this crisis. I didn't know anything about the discount window before I took this job. It's a pretty interesting device because each of the banks has already pledged assets that, with appropriate haircuts, more than cover for any money that they would take. So it's actually a pretty powerful liquidity device. And you remember the Federal Reserve was created in part because of the panic of 1907 and concerns about liquidity. So there's actually a very strong backstop for the banking system in this discount window. And so I do think it's important that it be functional and be used. I don't get caught up about whether it's used every day or not. I just want to make sure it's used when we need it and that it's available and accessed. And, I'm encouraged by some of the banks that have chosen to, and they've said this publicly, to go ahead and use it, even when they didn't need it, just to show that they could, because it shouldn't be a stigma thing. It ought to be a financing thing.
The utility, like anything. Are there, in your opinion, and we're talking in terms of a decade or two, term influences that might lead to inflation pressures or even de-anchor expectations? For example, is the Fed looking at such possibilities, such as COVID supply effects, reversal of globalization, increasing service-oriented economy, things of that nature?
Yeah, I mean, the future is always unknowable, and I referenced a couple of them. If price transparency is a big deal here, if I can go into Best Buy, see something for sale and get on my phone and check the price, and therefore, incent Best Buy not to raise prices, are the things that could work against price transparency. And that's where, who knows whether antitrust or other elements that break up some of the online providers would be relevant. If I'm worried about, call it a Walmart and their purchasing department, would deglobalization mean that you no longer could get access to lower cost supply from third countries, right? All those things are very real. You never want to assume that the past is the future. And so there are absolutely things that are possible and things that I watch closely. I don't know though. I got the funny feeling technology is going to move faster, not slower. And so I'm not among those who think that, I aggressively will not call myself a Luddite. And so I don't think we're going to go backwards there. And, I do talk to companies that are diversifying their supply. I think particularly in a COVID world, it's hard to make the case to just have all your supply in one country that might shut down. But I'm not sure so much of it's coming back onshore, and they're finding other low cost providers in places like Mexico or Vietnam or wherever. So, those two haven't quite hit me. And then it is worth just asking the question, are there forces that move the other way, right? We've had a lot of retailers go under in the last 6 months. What are the implications there? Are hospital systems going to consolidate and somehow hold down healthcare? There's a lot of those kinds of questions that I think are still very much out there. And so I think, as I said in my talk, there are inflationary forces, there are deflationary forces. We made an effort to try to, pump up against the disinflationary forces. If these inflationary forces come in, we actually do have a tool that's proven that has a lot of room to run, that we know what to do with. So, I think I would be attentive to it, but I wouldn't say I'm concerned about it.
A topic that we certainly discussed within our organization, and let's call it with other market participants, as our membership is very heavily involved in the economics and finance industry, is this sort of give and take right now between monetary policy and fiscal policy, and sort of the balancing act that's happening. And some say, I'm not saying who, but some say that the Fed is sort of leading the charge to the rescue and giving the fiscal policy sort of a freebie, if you will, while the Fed implements plans, policies, and procedures. In your opinion, is there a better balancing act? Are you guys, and you and others have mentioned that you're looking towards fiscal responsibility, or let's say fiscal capabilities, to drive the next wave of support for the economy as we come out of, ideally in the short term, this COVID situation? Could you offer any thoughts or ideas on where your thinking is with regards to that, please?
I might just say the following. It was the middle of March. Everything had hit the fan. We have a mandate to do what we can to promote maximum employment in the context of stable prices. And I think with Jay's leadership, we, did what we could there. And I think it was important to do everything we did. And I think it was the right set of things to do. And I do think it had a positive, impact. I'll also give Congress credit. I would not have guessed at the beginning of March that they could have come together as quickly as they did with a package as sizable as it was. And, different people will have different points of view on elements of the package, but I think in total, the support for individuals and those who are unemployed and small businesses and some industries in need was quite substantial. So a lot has been done there. What we've done, I think all that said, all of our assumptions back in March were that this was going to be a short-term thing. We were going to shut the economy down and open it back up. It's obviously been slower than that. And so, we've had to ask ourselves the question of how do we reset the gears given, what we see now. And I think Congress is having the same conversation itself about are there other things, it should be doing. And when I was in school, which was a while ago, but we learned about macroeconomics had two pieces, monetary and fiscal. We talked about both pieces, and we talked about, pulling both sets of levers as opposed to, just pulling one. And I think that's why you see me and others perhaps talking about it. And of course, in this crisis, we've added a third, which is public health, which is, if you can get infection rates down, people have more freedom to spend, more excitement to spend. They're willing to transact in commerce, and that also has a very real stimulative effect.
With these sort of implementations, and to the points that you were just making, there may be some concerns amongst the public about, let's call it Fed independence, and where that ultimately is going to lead, whereas it's just a sole focus on that. Combining that with sort of the concept of, let's call it unlimited power that has been discussed over time. Do you foresee a balancing act, and obviously, held to the COVID concern, but where does this ultimately lead in terms of what the role of the Fed is going to be in the economy going forward, or do you feel like that's sort of been addressed already?
So I was on the board of the Atlanta Fed in 2009, and I was so impressed with what the prior edition of the Fed did in the middle of the financial crisis. But there's no question that a second order outcome of that was intense scrutiny of the authority and the power that the Fed had at that time to intervene to support financial markets in the banking system. Dodd-Frank was passed. And again, I wasn't around for that, but I have to say, in this crisis, it's been, I think, quite useful for us to have a very clear mandate, which we do. And so we know what actions need to happen. And then I think real authority placed on the elected authorities who, who would give us the authority through the CARES Act or the permission, the Treasury Department, on some of these facilities. And so I hope when the postmortem is done on this, people will say, actually what the Fed did was follow the instruction of the constitutionally elected officials who described the limits of what our authority is, that we didn't act independently in the sense of going off on a tangent. We actually worked together with Congress and with the Treasury Department in the way that Dodd-Frank suggested to both get the authority and then constrain the authority. The rest of independence is around the very important role we play, vis-a-vis inflation and the like. And again, I think by behaving within the legal framework, I think we've done a really good job of, talking to both sides of the aisle and making clear we're doing what we can do in our box, but we're not trying to get out of our box. And I hope that will be helpful on the independent side going forward.
Yeah, thank you. Maybe a slight deviation from the topic at hand, but certainly something that is everyone is discussing, and a question that just came through. Should the Fed, as some of your colleagues have suggested, add the wealth gap between Black and white households to its mandate?
So our mandate says, maximum employment and stable prices with moderate interest rates. That's actually a somewhat broader mandate than some other central banks have, but it's one I think we've figured out how to operationalize. And I do think with the combination of the interest rate tool and the balance sheet tools, you've got the tools to do something. I think inequality is an important thing. I think the racial wealth gap is an important thing. I think you just have to ask whether we have the tools to work that. And I'd certainly hate for the credibility of the institution, and also for this really important set of topics, for us to give somebody authority over something without the tools to work it. And I guess I would just ask the question whether the tools we have are the right tools for that topic. I can think of a lot of other, more classically fiscal tools that, at least to my sense, would make a bigger impact on that topic.
Just one or two more, if you don't mind.
Sorry. Yeah, just one thing I should add to that. Obviously, if you flash back to February and you say we were at the end of a period of time where perhaps some predecessor Feds would have had rates significantly higher than we did learn, and this is what goes into our current monetary policy framework, that you can run lower unemployment than perhaps some had thought, and that does have positive impact on those various wealth gaps, not necessarily directly, but in terms of bringing people off the sidelines and into the workforce. And so that is very much our maximum employment objective. But again, to the extent we can do a little to help, I think that is a place we've learned something.
Interesting, because another question that sort of consistent with that theme is, and this is the question itself, you mentioned that you were humbled by the Fed's ability in the last downturn when you got onto the Atlanta board. With the Phillips curve having flattened since the early 1980s, how much control does the Fed have over inflation in the current period, given that backdrop?
So, I learned the Phillips curve when I was in college, and I do think that the wage Phillips curve, which is the Phillips curve I learned in college, is still very much alive and well. When it's hard to get workers, wages go up. They may not go up as much as they did in an era with more union power. They may not go up as much when you've got global labor supply available, but they still do go up. The question then goes, how much do prices go up? And I would agree, the connection between wages going up and prices going up is not quite as strong as it was historically, for the reasons that I talked about in my speech. And so, one of the reasons I said I'm humble about inflation is I think the word control is a really big word. It is clear to me that when you lower rates, you stimulate economic activity. It is clear to me when you stimulate economic activity that that plays through in wages and prices. And so I do think we've still got influence, but control is a bigger word. And we're in a world where, there are factors like price transparency and market power that are also having an influence on pricing.
One additional one, if you're okay with that. Shifting gears to your supervision regulation hat, what do you feel will be the impact to consumers and the economy of the lighter or non-supervision related to the huge volume of non-bank lending? And the examples that were provided were Rocket Mortgage, Quicken Loan, non-banks, et cetera, et cetera.
Well, I think, as I said earlier, I think it is really important for there to be a view of the entire lending environment. What you don't want for a health of the financial system is a lot of risk being taken, somewhere in the system without, eyes on them. They don't have to be our eyes, by the way, but they ought to be somebody's eyes. And, I'm reminded of long-term capital would be a good example in the late 90s of risks that were taken without eyes on them. So I do hope, and I expect that, most of the folks who are in that system, one way or another, someone will get eyes on them. I think there's been a lot of conversation about that in time.
Well, in all honesty, we thank you so much for joining us at this event. It's a huge honor for us, for you to speak to us and then take all the questions that you did. And we look forward to inviting you back, and hopefully in person next time. And we thank everybody for joining us. And we thank you for joining us at a Money Marketeers event. And thank you again, President Barkin.
Thanks. Great to be here, Alan. Appreciate it.
You're welcome. Bye now.